All right, thanks. And the introduction we had from Dan's very helpful here. So this is work with Pab at SMU, and also Tarun, who's formerly at Imperial, but now visiting LSE. So look, I mean, I don't need to rehash this except to kind of maybe get to the bottom part of this. So clearly, we've just seen how important kind of this component is to public infrastructure, and it's a large market, maybe somewhat smaller in relative terms, but nevertheless a large market and quite important. But there's a retirement element. That's certainly the component, the focus, I would say, of our time here together in some way. And tax advantage income's a big part of that, right? And so there's sort of a stable and conservative component. But while we've seen, that ownership is indeed concentrated within certain wealth deciles, or even smaller, there is also some component associated with an induced incentive that manifests in the data quite prominently, and that's about where, the U.S. states across them have very, very different tax policies, as we all know, and that engenders a kind of difference that then manifests in the relative attractiveness of some of these bonds relative to others, depending upon where you live. And that's going to be important. And so I would say, in some sense, what I want to talk about is a little bit that, just to show you some data, but also the interaction between these two components. From whom are we raising money, for what, but also who owns this stuff actually matters. And maybe there's a broader import there as well, which is, this kind of extends beyond to questions in the international space where we talk about, who owns our debt, as Dan kind of alluded to, matters. Secondly, we have questions of fiscal resilience. That doesn't happen that often in the muni world, though it did in 2020 during COVID. And so the Fed stepped in a bit to help. Clearly, there is an altered and shifting retirement landscape where more risk has been transferred to households. And I would say, perhaps most importantly here, capital markets are not frictionless. They have all kinds of idiosyncrasies, and that's quite prevalent here, where we have formally tax-shaped clienteles, right, which then engenders a kind of fragmented ownership and actually creates some degree of sensitivity that you might not see in every other space. And so I want to talk really a bit about that in some way. And so I'm not going to give you a giant model here by any stretch, but I will lean a little bit on some work that I did in an academic landscape a few years ago with some of these co-authors. And so just imagine a world where we have some local muni bonds, and then we have sort of a broader capital market in a way, and we can think about bonds outside and just ignore everything else from that standpoint. And so we also have two investors. And the investors here are inside of the state. And that's really important in this world because that means that then carries with it certain tax advantages. If I am living in a high tax state, meaning state taxes, and I'm owning a municipal bond that is issued by that state, that generates an additional degree of tax protection that is not only not inconsequential, but also quite varied and heterogeneous across the American landscape in a way. And then we could imagine other sort of bonds that sit out, beyond that are sort of global in nature and don't necessarily carry this kind of tax differential. And so the key parameter, in a way, is sort of the tax rate, right? Or actually, quite more formally, the sort of tax privilege that is afforded to that, and that is very highly correlated with that tax rate. Though it's a little bit more nuanced than that. There's some states that give some benefits or don't, but largely you can think about it as high tax states. There's a pretty big incentive to own the local bond. And so you could imagine a situation like this where we have kind of a high local tax rate, and then sort of global investors are going to be disinclined to invest in that because it's going to show up in the pricing of that bond. And then you're going to have sort of an altered ownership structure that is going to be sort of leaning into more local investors that starts to look more like a segmented equilibrium in a way. And then the flip side of that is a very low tax state or a zero tax state like Texas. Globals are going to participate. Pricing is going to be reflective of that. And risk is then going to be shared more broadly. And so the extent to which we see that, well, I'll sort of show you a bit of that in a moment. I will go through this relatively quickly. We don't need to really scrutinize the math. Let's look at words. Pricing equilibria reflect this. right? So on the left-hand side, what if the local investors are the marginal price setters? It's a large tax state. There's a huge incentive for local investors to own it and not for others. And sort of expected returns or yields, or however you want to think about it, are going to have different components. But the really important one is the last one that sits in this sort of orange color, which is there are going to then be state-specific kind of risk premia that are going to manifest because local investors are owning sort of concentrated exposures that don't get kind of washed away in our normal sort of risk-sharing arguments that we would imagine in other contexts. And then on the far right side, if risk is sort of broadly shared across the larger investor base, then this is going to be a more naturally determined equilibrium. And so the reality is, all states are sort of somewhere in between this, and you can imagine a kind of demand function for these bonds that have sort of interesting kinks associated with it, which is if the marginal tax rate is kind of high enough and there's this giant incentive to then own locally issued bonds, you get very different things. And so from whom are you trying to raise capital? What sort of risks are those local investors and hence retirees in aspiration? What kind of risks are they exposed to? And so there's a tax choice here that we sort of think about as being first order, but that also then has all of these sort of unintended or spillover consequences that are also quite important. And when this started, well more than a century ago, there was an idea to give this tax privilege to kind of gobble up a safe and reliable, investor base or a place from which you can reliably raise capital. But it has other unintended consequences as well. And so let me just tell you a little bit about some of the data. It's hard to see this, primarily because a lot of the investors in the muni space are households, right? And we don't necessarily get to see everything unless we're digging into some of the data that Dan mentioned. One place we can see this is in the municipal bond space, municipal bond mutual fund space, where there are products out there that are expressly designed to appeal to and target the clientele who want to invest only in California bonds because they live in California and there's a really nice sort of attractive incentive with that. And so here's sort of state funds in the first column, and then funds which are sort of designed to satisfy more the needs of a broader investor base. And so they invest in a huge collection of states and don't really have this same kind of focus. So if you look at sort of like row 3, the number of states held, these are investing in many, many different states. And then row 3 on column 1 is 2-ish. That's usually your state plus Puerto Rico, because you can pick up a little yield there, frankly. That's kind of what that is. And then you can see these state funds are investing disproportionately in longer maturity bonds, where important for local issuers in terms of trying to finance the things that we care about, frankly. And what is interesting is there is an evolution where some of this is moving more to the national space, and I'll talk a little bit about that, but this still remains quite important. And so at the end of the day, look, state funds are designed to concentrate, and they do, right? National funds are designed to diversify, and they do. And that's quite important, from that perspective. And so here, for example, is sort of a variation in privilege. So you can imagine your California or your Oregon or some of these others that are relatively high tax privilege, and there's a much, much larger representation of state funds that are, again, designed to deliver muni ownership patterns like this. And then you can see on the right-hand side, some others at the far extreme, for example, would be Texas, where this is just not part of the ecosystem, not surprisingly. Now, again, it's a little bit more nuanced. Wisconsin's an interesting one. There's a somewhat higher state tax rate, but the privilege is different there, and so actually you see them on the right-hand side. It's not just the tax rate, but it is very, very highly determined by that tax rate in a way. What else? Well, you can see some states that have made choices over time. So, for instance, Florida has made a choice over time, and so what's happened then is there is a removal of some privilege, and you can see the world responding, and that's very different from example for New York, which has a relatively high degree of privilege. So this is sort of the local ownership, at least through this, this delegated machinery. And on the right-hand side, for example, you see Texas there over time at the bottom. Not really present there. A lot of that's just not a place for this kind of mutual fund structure to operate. But Utah also makes some changes in the other direction, and so you see an explosion in this kind of activity, right? And so that's also quite interesting. This is a busy slide, but I think it's actually a really important one, so let me just walk you through it. So what we actually do in some of our econometric work, and I'll just give you a sense of it, is to say, okay, well, if you have a disproportionately concentrated ownership base that's local in nature, does this matter in some way? And so, for example, we run some econometric exercises where we look at, well, what if you have something that's associated with a kind of close election, right, that might actually matter in some way for fiscal policy going forward? Well, in situations like that, the states that are sort of undergoing a relatively close election, their yields are more sensitive to that if the ownership is more localized and segmented, and less so alternatively. In the middle one, what if there's sort of more local economic risk, and there are lots of different ways in which you could measure that. Again, that local economic risk has a greater implication for yield determination. There's more sensitivity there if the local investors are more prevalent, right? If we have a greater representation of local investors. And on the right-hand side, and this is really important, suppose you have municipalities that are trying to raise capital. They're trying to issue into this market. And in situations like that, the issuance implication for the yield sensitivity is, again, more pronounced if their local investor base, as it were, is disproportionately local. It's more segmented. And so notions of risk sharing or the ability to raise financing and such are definitely affected by this. And I think this has import for broader questions about how to structure government debt more generally, but it definitely matters in this market for sure. What else? Well, there's lots of other things to talk about here. So, for instance, there are many other ways in which this manifests, right? So if we're thinking about, primary issuance, so actually issuing into this market, well, there is this whole crazy network. It is not a market. It's markets plural, and there's zillions of them, and they're all the number of issues that Dan sort of mentioned. What in some other work we've done is to really describe the extent to which that network and that structure is very varied, and issuing into some markets are very different, depending upon that. And there's a whole ecosystem of underwriters that have kind of organized themselves around that space. You can see similar things actually if you look at the secondary market trading. So the dealers that help to facilitate, later transactions. Much of this is buy and hold, but a lot of this actually some of this does get transacted later. That too is a reflection of all of this. There's a lot of sort of things that have been happening over time. I think one thing that's quite interesting is there is a significant rise in things which look like mutual funds, separately managed accounts that are a little harder to measure, but they actually carry the same incentives. It's just different ways of trying to give households sort of a tax advantage. And so the incentives that I'm describing are rising. And this does have implications for the relative sophistication and such of who's owning this stuff and all of that, or if there are intermediaries that are playing a role. But institutionalization does not equal sort of full integration, and the segmented nature of all of this does persist. So let me sort of come back here, and then I'll sort of finish on this. So again, where did I start? There's a public finance issue, and then there's also a retirement issue, right? And you make choices in all of that in terms of what kind of tax policy are we going to do, but those have implications for what happens next, right? And so here, like the cost of capital that then is relevant for the markets from which we're trying to raise this financing, that is tied to the composition of who's going to own it. And in this case, in the muni market, that is quite important, and it's quite varied, right? Secondly, in tough states of the world, as they manifest, and we get hit with them inevitably, right? The resilience then also depends on who holds that debt, not just how much, right? And so some states are going to be more exposed to that, and you could imagine the analog if we start thinking about this more broadly in an international context. And then here's the other one, and Dan actually alluded to this a little bit, which is on the retirement security question. Like, this is a really important part of tax-advantaged sort of portfolios for those of us that are trying to, meet our retirement aspirations. And The households then are sort of there, but they are bearing this risk in a disproportionate way in the more high privilege states where the ownership concentration is more pronounced. And you sort of get this triple correlation in a way, where there's a local labor exposure, right? I mean, that's the world in which you are earning. There's local housing, so you obviously have asset valuations which are tied up with that, as well as munis, right? And so all of that is sort of now there together. And so I would say the segmentation that is a manifestation of these choices, they sort of link these two policy domains that are sometimes treated separately. I'll finish there. Thanks, everyone.